Joining us now on the phone with a closer look at bank earnings, the ones we've seen, the ones we're going to get. Chris Whalen, managing partner at Institutional Risk Analytics, a firm that analyzes financial risks based on FDIC data. Chris, what do you mean when you say they're not setting aside enough cash? What do you think is going to happen to make that cash necessary?
Well, it really depends on the bank. I've said that specifically regarding JP Morgan and Wells Fargo, because they have not done as much hard work as, say, our friends at Citigroup, who we upgraded yesterday. We actually gave them recognition for the amount of write-downs and other activities, especially sales of businesses that they've accomplished. They came in with a good revenue number at 25. As long as we can keep revenue north of 22 billion, life is good at Citi, because their expenses for provisions, which was what you were referring to before, should be trending lower. But what's interesting in all the calls so far is that there's still a lot of caution regarding the economy. Yesterday, the head of U.S. Bancorp said something very interesting, which was that his corporate customers don't need credit. They are awash in cash, but they're not spending the cash because they want to see the consumer first. And I thought that was a very interesting comment. They're very cautious at U.S. Bank, by the way. They're not talking about releasing reserves back into earnings, for example, which some of the lower quality banks have been gabbing about in the last week as a way of attracting investors.
So, Chris, it sounds like there's two key takeaway points. I mean, we heard, at least from Bank of America and also from JP Morgan Chase, that consumer exposure is still bad, but it's less bad. You just made reference to that. And then this idea that there's still fear rampant in the system. What does the rest of the year look like?
Well, first quarter is typically the best in the banking industry. Fourth quarter being house cleaning. At year end, the accountants look at the assets of a bank, and particularly what we call level 3 assets that are priced via models. So they always tend to clean house at the end of the year. So I would tell you that, if you look at Citi, I would expect to see revenues slightly lower as we go along through the year. Their fourth quarter tends to be weak. But they may end up looking fine. They say they can do $20 billion pre-tax, and I think that's not impossible if they keep moving along the way they have been. The rest of the industry, though, interestingly enough, is just now peaking in terms of charge-offs, realized losses. And what we're hoping, we're all crossing our fingers, is that it's going to trend down and that we're not going to stay at these levels of loss. But the key toggle is unemployment. The key toggle is consumer behavior, because if we don't see those two factors improve, then it's going to be very hard for the banks to get their loss rates down. And that goes back to your original question about the expense of putting aside reserves for future losses.
Chris, can you guesstimate at this point how much profit is courtesy of the Fed? The difference between 2- and 10-year Treasury yields, as you know, the so-called piggy banker spread, right? It averaged almost 3 full percentage points during the first quarter.
Well, that's correct. Net interest margin for someone like Wells Fargo is 3.5 points, which is extraordinary. The industry average is down in the high 2s. And, it's slowly changing because rates are very low. So as securities are redeemed, as loans are paid off, and they have to reinvest cash, it's at a lower yield, right? So that is a concern. And the other big issue for the banks going forward is interest rates. If we do see interest rate risk start to get thrown back into the equation, the banks today, who are largely unhedged and who are wide open in terms of funding, trying to maximize net interest margin, are going to have to buy their way out of those floating rate contracts. And there's some very blue chip names that I can think of, but I won't stomp on because, it's not appropriate. But it is suffice to say that funding and cost of funds and the yield curve, I think, are going to be more important this year than credit. I think credit is kind of yesterday's story in a sense, even though it's going to linger for a while.
Chris, I'm afraid we have to end it there. That's Chris Whalen. Thank you, Chris. He's the managing partner at Institutional Risk Analytics.